What is a partly paid up share and why is it traded in the market? Hello everybody, I'm your learning partner Sushila Hariharan, and if you're interested in a career in investment banking, trade life cycle, corporate actions and OTC derivatives, do subscribe to my YouTube channel where we provide content-centric, research-focused videos on these topics. So in equity markets, we often find that two types of stocks are traded on the exact underlying company. One is the stock itself, and sometimes the stock has a ticker which has got a term called as PP attached to it. That PP stands for partly paid up shares. It's not childish language, it's real adult speak. Okay, let's understand this. So, when a company is selling its shares to investors, it can decide the price of the share either through a book building mechanism or a fixed price mechanism. So when it decides the price of the share and the price of the share works out to, let's say, $100 per share, then investors are to pay $100 per share to subscribe to the share, okay, at the time of the IPO. So when the share price is this high, $100 is a high price for a share, and investors have to subscribe $100 at one shot, at a single instance, in order to get the allotment at the IPO. So what do companies do? Companies collect the capital from the investors at different stages. Okay, so as we know, the IPO price is a combination of the par value of the share and the share premium. All right, so the par value of the share and the share premium together, when summed up, gives us what is called as the IPO price. So when the IPO price is $100, let us say the par value is $10 and the share premium is $90, the company might call the entire share price in three different stages. Let's say they call it in stages of $40, $30, and the third stage is $30. So at the first stage, while applying for the IPO, they have to pay the $40 price. At the $40 price, they are allotted the share. But the allocation of this $40 in the books of the accounts is both towards the par value as well as the premium, thus giving rise to a concept called as PP shares, partly paid up shares. At $40, the par value is not fully paid up. That is, the $10 is still not fully paid up. It is pro rata distributed between the par value and the premium, and thus we find that the share is called as a partly paid up share. This share, even though it's only partly paid up, gets listed on the markets, okay, and hence you find the alphabet PP written next to the ticker. The second call for the share will be made within a few weeks of this, okay. It's not like it's going to happen after a very long time or something like that. It's going to happen within a few weeks of this. So the first call will be made, let's say, after 4 weeks of this. This is $30. Now the investor who has already having partly paid up shares might have sold the partly paid up shares in the market. He cannot pay the second call only and get the money because he is no longer the owner. The buyer who has purchased the partly paid up shares will now apply for the first call, that is $30 per share. So now there will be only the newly partly paid up shares, which will be at $70. So the $40 share no longer exists. All right, it has ceased to exist. The $40 partly paid up share has ceased to exist. Some people have the confusion that the share is partly paid up, both $40 as well as $30 both are separately traded. No, my friends, not at all. the partly paid up $40 share has ceased to exist and now it has become a $70 partly paid up share. The investor who's now holding the $70 uh, partly paid up share will trade in these shares. Depending on whether the investor wants to make the second call and the final payment, totally depends upon the investor. If they want to, they will continue to hold on to the share, and within a few days of this, the call is made for the final payment of $30. Now, what happens to the investor who's holding the share but does not apply to the remaining part? That means you're holding the $70 partly paid up share, but you somehow, for some strange reason, have forgotten to pay up the remaining $30 when the call had come to you from the registrar or from the issuing and registration agent. Then in that case, your entire share is forfeited. Excuse me. And you stand to lose $70 per share because of this mistake. Therefore, investors must respond to converting the partly paid up share into a fully paid up share so that they don't lose out on the opportunity. This is a very important aspect of understanding how the stock market prices not just fully paid up shares but even the partly paid up shares. If the investor forgets to pay the first call, the shares are forfeited. If they have paid the first call at the time of the IPO and the second call, but they've forgotten to make the third call at $30, then they lose the $70, which is also not very profitable. It is in fact quite a big loss for the investor because they have paid $70 and they stand to lose for the lack of being able to pay the remaining $30. Thus, investors have to be very careful about how they trade and how they treat partly paid up shares versus fully paid up shares. Thank you so much for watching.